Imagine running a business where you intentionally kick out your budget customers, you sell off your own real estate, and yet your profits jump 40%. We are looking at Lifetime Group Holdings today, ticker LTH. And this is their second quarter 2026 results. Let's get right to the headline here, because this was a massive beat.
Yeah, an absolute blowout.
Right. Now, I want to note for you that while the SEC filings and the earnings press release don't contain Wall Street's exact consensus figures or, the live tick-by-tick stock reaction when you look at the raw numbers, they effectively serve as a massive beat of both internal and market expectations.
Oh, without a doubt, the numbers speak for themselves.
I mean, we are talking about top-line revenue coming in at $866 million. That is up 13.7% year over year.
Which is a very solid top-line number on its own.
But then you look at the earnings. Diluted EPS hit 45 cents, a 40.6% jump, and adjusted diluted EPS came in at 48 cents, which is up 29.7%. And on top of all that, they raised full-year guidance across the board.
Yeah, they bumped 2026 revenue guidance to a range of $3.35 billion to $3.375 billion.
And adjusted EBITDA to a range of $940 million to $955 million, right?
Exactly. And the operational leverage on display in those figures is what should immediately catch the eye of anyone analyzing this quarter. I mean, net income hit $101.4 million. Like you said, that's a 40.6% increase over the prior year quarter.
Which is wild, right? Because they didn't just grow top-line revenue.
No, the fundamental equation here is highly efficient. When you generate a 14% increase in revenue, but translate that into a nearly 41% increase in net income, it means the underlying business model is capturing an outsized portion of every incremental dollar.
Right. It's not just empty calorie growth.
Exactly. This isn't empty calorie top-line growth driven by, unsustainable discounting or promotions. This is a structural flow-through straight to the bottom line. It indicates that the unit economics at the club level are scaling aggressively.
Well, if the unit economics are scaling, we really need to look at the underlying mix of how they actually generated that $866 million. Because when I was reading the filings, the actual volume of people walking through the doors does not mathematically explain a 14% revenue jump.
No, it doesn't.
Right. When you peel back the segment performance, total center memberships ended the quarter at 860,041. That is only a 1.2% increase year over year.
Yeah, raw volume is essentially flat.
So the metric doing all the heavy lifting here is the average center revenue per center membership. That figure surged 11.8% to $993.
Yeah, and management is executing a very deliberate pivot in their customer acquisition and retention strategy to get there. They're explicitly attributing this revenue surge to an improved membership mix.
What does that look like on the ground, though?
Well, the traditional gym industry model relies heavily on a high volume of low-paying members, right? The classic dosed member who pays like $10 a month and never shows up.
Right, the Planet Fitness model.
Exactly. But Lifetime is moving in the exact opposite direction.
Yeah.
They are intentionally decreasing their lower dues medical insurance memberships.
Which are usually third-party subsidized, right?
Yeah, they bring in foot traffic, but they severely cap the revenue yield per visit. So by actively cycling out those lower-tier memberships, they're clearing physical capacity on the gym floor for a totally different demographic, mainly couples and family memberships.
It honestly feels like watching an airline completely reconfigure a 747.
That's a good way to put it.
Like, they are ripping out the basic economy seats in the back of the plane just to install more first-class pods and premium economy rows. They are prioritizing yield over sheer volume. But let me ask you, are they intentionally shedding these budget users just to build a premium pricing moat?
I mean, the physical footprint of a Lifetime center essentially dictates that strategy. These are not little strip mall gyms. They are massive 100,000-plus square foot facilities. Management actively markets them as athletic country clubs.
Right, they are huge.
And a building of that size has a strict limit on capacity before the customer experience starts to degrade. If the club is just flooded with lower dues members who, scan their card, use a treadmill for 30 minutes, and leave, the company is increasing the physical wear and tear on the facility without maximizing the revenue yield of that square footage.
That makes total sense.
But a family membership changes the economic profile of a single visit. Those members are paying higher base dues, obviously, but more importantly, their dwell time in the building is significantly longer.
They stay for hours.
Exactly. They purchase lunch at the Life Cafe. They enroll their children in the Kids Academy. They utilize all these premium add-on services.
And we see that behavior reflected directly in the in-center revenue, which jumped to over $240 million for the quarter.
It's massive.
Yeah, members are not just accepting the higher dues. Their utilization of offerings like dynamic personal training is up significantly.
Well, the upsell's the core of the strategy. Once a consumer commits to a premium-based price, the psychological friction of purchasing high-margin ancillary services drops.
Oh, interesting.
Yeah, dynamic personal training is a perfect example of a high-margin service that relies entirely on a highly engaged, captive, and affluent audience. By filtering out the budget consumer at the front door, they ensure that the people walking the floor actually have the discretionary income to support that 240 million in-center ecosystem.
So they're essentially operating luxury resorts at this point.
Pretty much.
But that kind of white glove experience requires a massive amount of overhead. If revenue is up 13.7%, what is happening to the cost of actually running these massive buildings? As investors, we have to track how much of this premium pricing is getting eaten by the cost structure.
Right, margin creep is always a risk.
Yeah, so looking at the margins,
Yeah.
adjusted EBITDA hit $246.5 million. That's a 16.8% increase, and the net income margin improved to 11.7%. But center operations expenses rose 12.3% to $453.7 million.
True, but a 12.3% increase in operations expense, running parallel to a 13.7% increase in revenue. That is a sustainable, healthy ratio for this specific stage of their growth cycle.
You don't think it's administrative bloat?
No, not at all.
Yeah.
It is directly tied to the utilization dynamic we just discussed. If a facility has higher in-center utilization, like more members taking specialized classes, buying food, or dropping kids at the Kids Academy, the variable labor costs to staff those specific revenue-generating centers will naturally rise.
That's a good point.
Plus, they're absorbing the heavy initial operating costs of ramping up all the new centers they've opened in recent quarters.
Okay, the labor and the ramp-up costs make sense. But digging into the filings, there is a notable risk in this cost structure regarding their real estate strategy.
Oh, rent.
Yeah. Rent expense jumped 13.3% to $94.3 million for the quarter. And this is driven by their sale-leaseback strategy where they, build a club, sell the physical property to a real estate investor, and then lease it back.
Right.
But what really stands out to me is this concept of contingent rent. According to the filings, their rent actually increases based on a percentage of the center's financial performance.
Yeah.
If the club hits specific revenue targets, they owe the landlord a larger check. I have to push back on this mechanic. If they are paying higher rent precisely because their clubs are successfully upselling premium members, isn't contingent rent essentially a margin penalty for their own success?
That's exactly what it is on a
Yeah.
micro level. If you are analyzing just a single mature club, your assessment is totally correct. As the club crosses a predefined revenue threshold, the variable cost of the contingent rent kicks in and begins to eat into the incremental operating margin of that specific location.
Because it caps their profitability.
Yeah, it establishes a soft ceiling on the four-wall profitability of their most successful buildings.
It just seems like a frustrating trade-off. You execute this complex strategy to pivot to affluent family memberships. You drive up in-center spending on personal training, and then you are contractually obligated to hand a percentage of that hard-earned operational success right over to the landlord.
It sounds bad when you frame it like that. But to understand the logic behind accepting that micro-level penalty, you have to zoom out and examine the macro capital structure of the company.
Okay, how so?
Well, constructing a premium, ground-up athletic country club requires tens of millions of dollars in upfront capital expenditure. If Lifetime holds that asset on their balance sheet, that massive amount of equity is essentially trapped in the concrete and steel of the building.
Right.
The sale-leaseback strategy is a mechanism to aggressively unlock that capital. By selling the physical asset to a third party, they receive an immediate, massive influx of liquidity.
I see where you're going.
Yeah, the return on invested capital they can generate by taking that cash and immediately deploying it to fund the construction of 3 more clubs, for example, far outpaces the localized margin degradation caused by paying contingent rent on the original property.
Wow. So it is essentially the corporate equivalent of pawning your house to buy 3 more houses, but just hoping the rent you pay on the first one doesn't eat the profits generated by the new ones.
That's a colorful way to put it, but yeah. They're trading peak four-wall margins on mature clubs for immediate liquidity. and that allows them to expand rapidly without taking on massive amounts of traditional bank debt.
So they are actively deciding that they are an operator of premium health ecosystems, not a commercial real estate holding company.
Exactly. The contingent rent clause is simply the cost of capital required to execute an asset-light growth model. Real estate investors demand upside participation via contingent rent in exchange for providing the upfront liquidity. For management, maintaining a flexible balance sheet is way more valuable than capturing the final few percentage points of margin at a mature location.
Okay, if the entire purpose of the sale leaseback strategy is to free up massive amounts of capital, how exactly is management deploying that cash? Because looking at the balance sheet and their forward-looking strategy, they're making incredibly aggressive moves simultaneously.
Very aggressive.
First, the balance sheet deleveraging is stark. Their net debt leverage ratio dropped dramatically to 1.4 times, down from 1.8 times just a year ago.
And that level of debt reduction actually prompted credit rating upgrades. Both Fitch and S&P bumped their issuer credit rating to BB.
Which is a huge deal for them.
Crossing into a BB rating is a significant milestone for their capital structure. I mean, while it's still in the high-yield category, moving up the rating ladder lowers their future cost of borrowing.
And it sends a message to the market, right?
Exactly. It signals to the institutional market that their cash flow generation is highly stable and easily covers their debt service obligations. When a company can organically lower its leverage ratio by 0.4 of a turn in a single year, while simultaneously growing top-line revenue by 14%, it indicates a massive amount of free cash flow generation.
And they are certainly not hoarding that cash. On the capital returns front, the board authorized a $500 million share repurchase program back in February of 2026.
Yeah, and they're already executing on it.
Right. In the second quarter alone, they bought back 2.2 million shares for $62.7 million. That is an average price of $28.59 per share. But the buybacks aren't slowing down their physical expansion either.
No, not at all.
They are utilizing the liquidity from the asset-light model we just discussed to fund an aggressive development pipeline. They're on track to open 14 new clubs in 2026. And they actually tightened that guidance. Previously, it was a range of 12 to 14, and now they are committing firmly to 14.
And these are not small retrofitted spaces.
No, these are predominantly large format, ground-up builds. The 2026 class of clubs will total roughly 1.3 million square feet, which is double the footprint of the 2024 and 2025 classes.
The velocity of their capital deployment is just remarkable. And in addition to the new footprint, they are accelerating their capital expenditures for modernization within their existing real estate portfolio.
Like the new training formats.
Yes, specifically, they are accelerating the rollout of CTR and Hybrid XT group training classes.
We should probably define those formats for the listener because they tie directly back to the revenue strategy. CTR and Hybrid XT are specialized, high-intensity, premium class formats. They require dedicated floor space, specific equipment, and specialized coaching.
Right. These aren't your standard included with membership aerobics classes.
Exactly. They are designed to drive up that in-gym spending metric we talked about earlier by offering boutique-style fitness experiences under the same roof.
By integrating those boutique formats into their massive facilities, they are aggressively attacking the market share of niche fitness studios. But executing all of this, the modernization capex, the 1.3 million square feet of new builds, the 62 million in quarterly buybacks, and the aggressive debt paydown, it requires an immense amount of structural liquidity.
Right.
Doing all of this simultaneously is highly unusual without severely straining the balance sheet.
Which brings up the ultimate question on this corporate strategy. They are doubling their new square footage, they are retiring millions of shares of their own stock, and they are paying down debt all at the exact same time. Is this the perfect corporate flywheel, or are they running too hot and risking a liquidity crunch if the market turns?
Well, the math behind the flywheel relies entirely on the predictability of the sale-leaseback pipeline. The operating cash flow generated from the $993 average dues provides the baseline stability, sure, but the real accelerant is the real estate monetization. Management highlighted in the filings that they expect to complete $400 million in sale-leaseback transactions in 2026 alone.
$400 million in 1 year.
Yeah. That $400 million cash infusion is the bridge. It is what allows them to self-fund the massive 2026 development class and buy back stock without tapping traditional debt markets.
That makes sense.
And the share repurchases in particular are a massive signaling mechanism. By buying back stock at roughly 28 bucks a share while continuing to build out physical clubs, management is telling the market that they view their own equity as deeply undervalued relative to the cash they know they are going to generate from these new locations.
So it all hinges on the real estate market.
Basically, as long as institutional real estate investors maintain an appetite for purchasing lifetime properties, the flywheel functions perfectly. They are funding exponential growth through structural cash generation, not over-leverage.
Stepping back from the raw capital allocation and the real estate engineering for a minute, what is the actual asset they're building for the consumer here?
It's an ecosystem.
Exactly. Lifetime is clearly attempting to construct a total lifestyle ecosystem, moving far beyond the traditional definition of a gym. The filings detail their operations outside of the fitness floor, and it's fascinating. They're currently running 15 Lifetime co-working locations and 4 Lifetime living luxury residential properties.
Wow.
And all of these are physically integrated with or adjacent to their athletic country clubs. Furthermore, they are investing heavily in a digital tether, an app called LAIC.
Yeah, the LEAC app functions as an AI-powered health companion. It is designed to track metrics, suggest programming, and keep a consumer engaged with the brand even when they are physically outside of the building.
Right.
When you combine the digital companion with the physical real estate extensions, the strategy becomes incredibly clear. They're engineering incredibly high switching costs.
Absolutely. If a consumer is merely paying for treadmill access at a legit gym, canceling that membership requires zero friction. You just walk away.
Yep.
But if you live in a Lifetime residential apartment, you lease office space in a Lifetime co-working facility, you work out in the club, and your daily health data is centralized in their proprietary AI app. Leaving the ecosystem becomes an exhausting logistical undertaking. You aren't just canceling a gym membership, you are actively disrupting your entire daily routine and your social infrastructure.
And that ecosystem approach is the ultimate defense mechanism against customer churn. It justifies the premium pricing by integrating the brand into multiple facets of the consumer's daily life, significantly raising the barrier to exit.
Which leaves us with a final provocative thought for you to ponder based on everything we've covered in these filings today. As Lifetime pushes aggressively into this ultra-premium, high-dues, full ecosystem territory, how insulated is this specific athletic country club consumer from a broader macroeconomic pullback?
That is the million-dollar question.
Right. Traditional logic dictates that gym memberships are highly discretionary. They're often the first expense cut during an economic downturn. But by targeting the highly affluent consumer and integrating into their housing and workspaces, are they building a recession-resistant economic fortress? Exactly. By relying on nearly $1,000 in average revenue per member, are they uniquely exposed if the upper middle class finally has to tighten its belt? The durability of this premium pricing model in a volatile economy is absolutely the key dynamic to monitor in the quarters ahead. Make sure to follow the show for your daily, no-fluff earnings coverage.